Hello everybody, what's going on? Few important updates are coming from NIO's end. If you have been watching the electric vehicle space, you know the narrative from past few years has been all about raw growth, delivery numbers, and burning cash to capture market share at all cost. But the tides have officially turned. The market doesn't want potential anymore. Wall Street and global investors want one thing: real bottom line profitability. And that brings us directly to the NIO. At a science and innovative forum in Shanghai, NIO founder and CEO Li Bin dropped a statement that should be music to every growth investor's ears. He stated flat out that profitability is the ultimate metrics for judging the value of tech driven companies. Now, coming from a startup founder, that might sound like standard corporate speak until you look under the hood of what NIO has actually achieved over the past few quarters. This isn't just talks. NIO is undergoing a massive structural shift from a cash burning EV underdog to an ecosystem powerhouse that is proving its long term bull thesis. So, let's unpack why this shift makes NIO one of the most compelling long term opportunities in the EV space right now. To understand where NIO is going, we have to look at how they got here. For years, bears pounded the table on NIO's burn rate. And to be fair, building out a proprietary battery swapping infrastructure across China and Europe wasn't cheap. It kept the company in the red for a long time. But looking at the operational turn, last fourth quarter, NIO achieved positive profitability for the first time. Then Q1, they backed it up with an adjusted net profit of 43.5 million yuan. They didn't just hit a fluke quarter. They proved that two consecutive quarters of non-GAAP profitability wasn't an accident. And they did this while outperforming the broader Chinese auto market. In the first half of this year, when overall auto sales in China actually dropped nearly 20%, NIO delivered a massive nearly 70% growth in vehicle deliveries year over year. Think about that for a second. In a shrinking macro environment, NIO didn't just survive, they captured market share aggressively. William Lee pointed out that the competition in the new energy vehicle sector is entering brutal final phase. The next 1 to 2 years are going to separate the winners who build sustainable business from the losers who run out of runway. The era of brand choice and relying on a single gimmickly feature is over. The market is shifting to system level competition, and this is precisely where NIO's long term strategy pays off. Most analysts look NIO strictly as a car manufacturer. This is a fundamental mistake, I would say. William Lee highlighted something crucial: vehicle sales are only one segment of the automotive value. The true differentiator for NIO and the secret engine behind their path to sustain margins is their full value chain monetization, especially their service and community ecosystem. NIO services and community revenue include after sales service, used car operations, technology exports, auto insurance, financing merchandise via NIO Life, and most importantly, their energy service, battery swapping, charging, and upgrades. For the full year of 2025, that segment surged 41% to reach 10.6 billion yuan, crossing 10 billion yuan mark for the first time and achieving standalone full year profitability. So why is this massive for the stockholders? Because while vehicle margins can fluctuate with commodity prices and pricing wars, high margin recurring revenue ecosystem creates a resilient financial moat. Every car NIO puts on the road becomes an active subscriber to their energy and service ecosystem for years to come. That energy infrastructure, which critics called a money pit for years, is turning into their highest margin asset. CEO William Lee admitted that sticking to this strategy wasn't easy. Investors, market, and internal teams put pressure on leadership to ditch the battery swapping network and focus strictly on cheaper short-term plays. But they stayed disciplined on long-termism. They weathered the storm, absorbed the upfront capital expenditure, and now they own the irreplaceable network that competitors simply cannot replicate overnight. When you evaluate tech driven firms today, you have to look beyond next quarter's delivery figure. You have to evaluate the business model's ultimate viability and its depth of user relationship. Now, user has built a fierce, loyal user community combined with full value chain monetization. They are expanding their footprint, driving software and energy monetization, and proving that their business model scales into bottom line profitability. The consolidation phase in the EV industry is here. The weak hands are getting shaken out, but NIO has crossed the threshold. They have proven they can achieve profitable quota, grow deliveries by 70% in a down market, and monetize an infrastructure ecosystem that generates over 10 billion yuan on its own. So, if you're a long term investor looking for an EV company that isn't just building cars but building a profitable end to end technology ecosystem, NIO's execution validates the entire thesis. The transition from heavy investment to scalable profitability is happening right now, making the risk to reward dynamics on NIO looks exceptionally bright for the year ahead. So prepare now because in future we will see more and more profitable quarters, and because of that big institutions will buy NIO shares, and then we will see some good momentum in its stock price as well.